Ladies and gentlemen, good day and welcome to the Q3 and 9 months FY23 earnings conference call of Mrs. Bector's Food Specialities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Bector, Managing Director and Promoter. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone. On behalf of Mrs. Bector Food Specialities Limited, I extend a very warm welcome to all participants on Q3 and 9 months FY23 financial results discussion call. Today on this call, I have with me Mr. Manu Talwar, Chief Executive Officer, Mr. Ishan Bector, Whole-Time Director, Mr. Suvir Bector, Whole-Time Director, Mr. Praveen Kumar Goyal, CFO and Whole-Time Director, and Orient Capital, our investor relationships consultant. I hope everyone had an opportunity to go through our investor deck and press release that we have uploaded on exchanges and on company's website. Firstly, I am pleased to share that we have crossed previous full year revenue and EBITDA in 9 months of current financial year. I am glad to share the company has reported strong quarterly and 9 months financial numbers, supported by revenue growth in both domestic and export markets. The company is satisfied with the double-digit revenue growth for both biscuits and bakery business. As we mentioned in our previous earnings call, we are strengthening our leadership team to lead our business and support functions. The company continues to increase its distribution footprint in existing and new geographies, build manufacturing infrastructure, digitization in selling and distribution, along with marketing and brand initiatives. In Q3 FY23, the revenue grew by 40% on year-on-year basis, witnessing good growth across business verticals, and improved our EBITDA margin to 13.9% as compared to 12.6% in Q3 FY22. We will continue to increase our competitiveness by innovating and introducing new products in the premium category of biscuits and bakery. Our consistent performance is reflective of our strategic clarity, marketing initiatives, excellence in execution, strengthening core team, technology adoption, and increasing distribution reach. Also, I am pleased to share that we have declared interim dividend of rupees 1.25 per share. Now I will discuss the Q3 financial performance. The consolidated revenues for the quarter stood at rupees 368 crores versus 263 crores in Q3 FY22, thus registering a growth of 40% on a year-on-year basis. In biscuits segment revenue for Q3 FY23 stood at 219 crores against rupees 157 crores in Q3 FY22, thus registering a growth of 40% compared with Q3 FY22. This includes domestic and export biscuit segment. Biscuit segment has grown by 50% as compared to Q3 FY21. Both domestic and export business has grown by higher double digits in Q3 FY23 as compared to same period last year. Bakery segment revenue for Q3 FY23 stood at 127 crores against rupees 92 crores in Q3 FY22, thus registered a growth of 38% compared with Q3 FY22, including retail bakery and institutional segments. Bakery segment has grown by 77% as compared to Q3 FY21. Both retail and institutional bakery has grown by higher double digits in Q3 FY23 as compared to the same period last year. Margins. EBITDA stood at 51 crores, saw a growth of 54% year-on-year. Our EBITDA margin for Q3 FY23 was 13.9% as compared to 12.6% in Q3 FY22. PAT stood at rupees 28 crores, saw a growth of 79% year-on-year basis. Our PAT margin for Q3 FY23 was 7.5% as compared to 5.9% in Q3 FY22. Moving to 9 months performance, the consolidated revenues for 9 months FY23 stood at 1,016 crores versus 736 crores in 9 months FY22, thus registering a growth of 38% on a year-on-year basis. Biscuit segment reported a revenue growth of 34%, which stood at 604 crores in 9 months FY23 as compared to 450 crores in 9 months FY22, including domestic and export sales. Bakery segment revenue 9 months FY23 stood at 360 crores against rupees 244 crores in 9 months FY22, thus registering a growth of 47% year-on-year. EBITDA for 9 months FY23 stood at 127 crores, saw a growth of 31% year-on-year. Reported an EBITDA margin of 12.5% as compared to 13.2% in 9 months FY22. PAT stood at rupees 62 crores, saw a growth of 33% year-on-year. With this, I would request to open the floor for questions and answers. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Dani with Ponak Network. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations on a very good set of numbers. I have a couple of questions. My first question is about a distribution. Just want to know, we had given a target in the last call. Where have we reached, and what is the outlook there? My second question is regarding how the export market is paving out for us. If you could just throw some color. And my third question is regarding the update on the capex plan and where have we reached so far.
Okay. So, thanks, Rahul, for your best wishes. Let me take up your first question on distribution first. Yes. So what we have shared in the previous 2 calls also, that we are on a journey of strengthening our distribution. And distribution is strengthened with taking 4 key actions. First, also expanding on the feet on street, where we told last time also that we have done that. We had a target of expanding our feet on street to 850, and which we have reached, and to expand our distribution. Second thing which we had was to do on the input side was to build the capability and have a well-designed sales training program. So our company and Potential Learning created a joint learning and training program for the capability building of the sales team, and we executed the first leg of that, which is again showing us good results, and we have just started the second leg of that training. Right. Third thing was to implement or digitize the sales through SFA. So we have implemented SFA in the April, May of this year, which is through which we are able to track all the sales KPI, whether all the beats, how many people are the beats are starting on the right time, what are total calls we are making, how many calls are productive, what are the lines sold. So all these KPIs are being monitored on a daily, weekly, and monthly basis to improve that. So these were the three KPI action or three input KPIs which we are working upon and have worked upon. And we had a clear-cut target that by March 24, we will double our direct reach outlets to 320,000, and we are on the way. We are progressing absolutely well to achieve that target, and by this March, we will be at the midway point. And we just got a latest estimation report also, which also kind of validated that we have moved and we have now reached total outlet reach, this is indirect outlet reach of 6 lakh outlets. So this is on the distribution side. And I missed out one point. Last time we also briefed you that we'll be implementing DMS, which is Distributor Management System, which we have partnered with Bector. The implementation is underway. By March, we would have implemented all our large distributors, and the balance will be done in the H1 of next financial year. So this is on distribution side. Today morning was the time when I reviewed the distribution plan for the next financial year also. So we have executed as per our plan so far, and we are on the right path to keep expanding and taking it forward into the next financial year. Your second question was on the export side, and as our MD said in the speech also that we have grown well both in domestic and international export market. So export market is doing very well for us. We have not only grown well, we have also improved our realizations very well in the international market, and we are as of now focusing more on Middle East market to make it a critical market over next 3 to 4 years time. It doesn't say that we are not focusing on other markets. Our focus also continues to be North America, Canada, and East Africa side. So export is doing well for us, very well for us. It is growing in almost all the geographies with a large focus on distribution and execution in the Middle East market. And objective is that over next 3 to 4 years time, we should be able to create a strong Cremica brand market in Middle East. The last question which you were on the CapEx, which again in line what we briefed last time to you with one addition. Now, so we have Rajpura, we are adding 2 more lines, which will work is in progress. It is well in time, and in Q1, both these lines adding almost 2,000 ton capacity per month will be commissioned in the Q1 of next financial year. Other than that, we are also expanding our bakery capacity for the NCR and the nearby cities. So we are putting up a bakery line in Bhiwadi, which is close to NCR, and this line will be commissioned in the Q2 of next financial year, which will give us additional capacity of 80,000 pieces of bread on a daily basis. Third, what we briefed you last time was that we are finalizing a plan of putting up a state-of-the-art bakery plant in Khopoli, and that work is in progress. Land has been acquired. We are in the final stages of negotiating with machinery suppliers, and layout of the factory has been almost finalized. This will be commissioned in 24-25. And the other one was putting up a biscuit plant in MP. So that also plans have been finalized, and The work of boundary line construction has started. Plant construction should start in another 40 to 60 days time, and we can again expect this plant to be commissioned in the financial year 24-25. So these are our supply chain manufacturing capex plans in terms of expanding our capacity to keep feeding into our growth.
Sure, sir. So just one last question from my end. Just on the margin front, you had alluded to about 14% by end of Q4, but you've already achieved that right now, almost there right now. So what's your outlook on margins and where do you see this? And if you could just help us with the number in exports of our brand versus outsourced brand, the percentage.
Both our division between our own brand and outsourced brand is just about close to 50-50. So just to answer that. On a margin side, Rahul, I think we've been maintaining that we are doing a journey of 30 to 14% and consistently delivering it, right? So I would say that we are still on the journey of doing this journey of 30 to 14% and deliver it consistently before we take the next leap of moving from 14 to 15%, which we aspire to reach over the next few quarters.
Sure, sir. Thank you so much and all the best.
Thank you. Our next question is from the line of Percy Panthaki with IIFL. Please go ahead.
Hi, sir. For the biscuits segment, can you give some flavor as to how different is the growth rate in the domestic versus the exports?
It's very similar. It's very interesting that so it's very similar. Both are in high teens.
Sir, isn't it closer to 40%?
Yes, revenue growth, yes. It's between 30, it's about 30%. So it is between 30 to 40, both are in the same range.
Okay, understood. And how much of this growth in your view is coming because you are expanding distribution and there is an initial sell-in into the channel which would be driving some part of this growth. So can you probably try and quantify how much is the impact of that?
It is largely because of distribution expansion and selling execution, S&D execution. So I would say there are two parts to it, and I will explain to you. One is the distribution expansion and selling, improving the sales execution in the marketplace and the discipline. These are the two large factors of sales growth.
So what I'm trying to get a handle here, and don't get me wrong, your efforts are very much appreciated. But sometimes what happens is that when we expand the distribution, then somehow after a few months it doesn't work out and we may not get repeat purchases. But in the initial sort of few months, we get the benefit from the fill-in into the channel. So I am just trying to pass that channel expansion-led sales growth out so that even in the worst case, if those new outlets do not have repeat purchases, then we can still bank on at least the other outlets which have been serviced since the last several months or years, and that part of the growth is at least secure. So I just wanted to understand that.
So just to explain to you, and journey for any FMCG company, right? So what we said, by hiring more feet on street, by training them, by measuring their performance to Salesforce automation and now going to DMS, we are going to double our outlet from start of this financial till March 24, territory outlet and reach to 320,000. So as long as we are able to do it, this sales will continue to show a momentum, right? And we are at a very low level of coverage. We have a large ground to cover. So as a company, we have a large ground to cover. So this is a worry for a company which are at very high level of penetration, right? We have a long journey to do in terms of adding our distribution, adding more towns and geographies to keep expanding, and in the same city also to add more outlets. And that's primarily the journey which is done by every FMCG which moves up the distribution expansion.
Secondly, I wanted to understand for the B2C breads business, what is basically the change in salience of the non-north markets? So basically your Bombay, Pune, Bangalore, etc. What percentage are they contributing today versus what percentage they were contributing 2 or 3 years ago?
I would request Ishan to pitch in because I know the current one. Ishan, you there?
Yeah. So, Percy, I would request you to sort of look at it not as north, west, and south because initially we were only in the Delhi NCR market. What has now also opened up for us in north is the outstation areas, which I have also been mentioning on the previous calls. So for us, north also was a city-focused territory, which is now sort of becoming bigger in terms of opening up new cities, outside. So, for us, our largest growth is coming from the north, but it is not only on account of Delhi NCR, it is also on account of opening newer cities outside of Delhi NCR, where we are now getting stronger in terms of market share in cities in Uttar Pradesh, Haryana, as well as just touching Punjab.
Can you name a few of these cities?
So it would be Agra, Jaipur, Chandigarh. These would be the big ones. We have also started in a way to open up Lucknow, but this is still at a very nascent stage. So, I mean, we are focusing on the big cities to get market share, which will also help us put up infrastructure, new plants in the years to come to support larger markets.
And any reason why we have not seen that same kind of success in west or south?
No, we've seen great success in west as well. We have in west market we would also be growing at about 35% on a volume basis, and that's why we have been we have also taken up some outsourced capacity. And are also in the plans of forming up our new plant in Khopoli. So the brand is growing well in all markets. I'm just saying that it's not, our contribution of north, south, west would probably remain the same because north is also being fueled by many other cities in the north.
Understood. And lastly, on export biscuits, can you give some idea as to how we are getting this explosive kind of growth?
Hello?
Hello?
We have also, so you can answer that.
Yeah, hi Percy. So we're really expanding, we're opening newer markets. We are also newer customers. Now, to give you an example, like how CEO Manuji was saying, we're really penetrating into the Middle East. So we've appointed now this our brand, Cremica, in almost all of the GCC markets. So whether it's the Qatar, Saudi, Bahrain, or even if you go to the market, we'll have our products present in the market. And we are also trying to penetrate in markets where we're trying to enter the leading with the consumer-driven promotion. So this is all these are sales, and also with a focus in trying to work with established retailers. So that's in growing a business.
Thank you. Mr. Percy Pantaki, may we request that you return to the question queue for follow-up questions, as there are several participants waiting their turn. Thank you very much. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 to 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Our next question is from the line of Mr. Harit with Investec. Please go ahead, sir.
Yeah. Hi, good evening. I just had two quick ones. One was on the breads business. So, what's the differential in growth between, say, the domestic piece and the institutional piece? Are they broadly similar, or there's a big gap there this quarter?
So, Harit, you're asking about institutional. So between the institutional and B2C business of bakery, right?
Right.
So, you see, both these businesses are going in double digits in their IT, right? Both have a fairly in a range similar kind of growth. Both are growing high teens. Just to answer your question, the volume increase in both in this quarter is in IT.
Okay. And the second question, was on margins. So I think you mentioned 13 to 14% is the journey that you're at, and you move to the next one over a period of time. But if you look at the material cost environment right now, how are you seeing it? Do you see incremental pressures over the next, say, couple of quarters or next 2-3 quarters as the new season of wheat prices kind of come through? In that context, how do you look at pricing, given in certain parts of your business you don't get pricing immediately, like in the institutional guides? I think it's an annual kind of a number. So how are you thinking of that? Are you pretty confident still of 13 to 14% in spite of possible headwinds going forward?
Yeah, Harit, I'm Anup here. So, basically, if you look at our business, last year had been one of very, very difficult years, which was with very, very high inflationary, and we took time to increase the prices. Now, what has happened is our price increases have happened, and the complete full year price increases will come into the company. Also, what we see is softening of certain raw materials, which will definitely assist the company, to achieve these targeted numbers. So we are working towards it. I do not feel there would be a challenge on getting the numbers right on the EBITDA and the PAT.
Great. Those are my two questions, Anuj. Wish you all the best. Thanks.
Thank you. Our next question is from the line of Q3FY23 with Unifi Capital. Please go ahead.
So my first question on the growth outlook for the coming years. So you had a phenomenal FY23. See, on this high base, how are you looking at growth for each segment? And can you break up the growth between expanding the distribution reach and what is the like-to-like growth numbers?
So in terms of growth, I know we have a very impressive growth this year across our business segments. So, but our plan for next year, which is still in the last stages of finalization, we are looking at a high teen growth. So,
and this is for volume or revenue? High teens?
Revenue, yeah. High teen growth in revenue. We're looking at that.
And how much of this is because of adding new distribution outlets, and how much is because of the existing outlets?
So it's very difficult to differentiate that what percentage will come from the new outlet. But you see, the growth will come from two ways. Existing outlets, we need to increase our throughput, right? And we need to premiumize. Very important. We are on the journey of increasing our contribution, and we've done fairly decently, but we have a much stronger plan for next time.
Thank you, sir. That's all from my end.
So that is our plan. Can you hear me?
Yeah, I can hear you now.
Right. So that's the plan we have to do a journey of premiumization.
But along with that, there is a strong plan of driving our distribution and taking it up. So both these factors combined will help us to achieve our high teens revenue growth both the segments.
Thanks, sir. That's helpful.
Thank you. Our next question is from the line of Mr. Amit Purohit with Elara. Please go ahead.
Yeah, sir. Congratulations. Thank you so much for the opportunity. Just, sir, on the distribution side, you indicated that you have made some plans. If you could highlight, I remember last year you were talking about some 5 lakh outlet reach. Now we have reached to close to about 6 lakhs. So what is you have highlighted the direct reach outlook of 320. I just wanted to know what would be the overall reach, maybe FY24 and 25, if you would help.
So, as I said that by March 24, on our direct reach, we want to reach a 320,000 outlet mark. When we started the year, we were at 160. So we want to double the outlets over 24 months time. As we are doing this journey, AC Nielsen report that we have moved from a 5 lakh kind of indirect reach to close to 6 lakh. So we expect a similar kind of growth should come to us in the next year also by the March 24. Right, so it is very difficult to find out that exact equation of between direct to indirect, but taking the trend line, I think that we should be by end of March 24, we should be reaching close to 7 lakhs approximately indirect reach of outlets.
Yeah, okay. And sir, just on the bakery side and comparing biscuits, so which, according to you, or how do you position each when you enter into new markets, and which is the easier one as of now? I mean, relatively, I know both would be tough to get into the markets, but I'm generally saying that where the acceptance from the consumer or your positioning is better and hence easy to scale up.
So first thing, both businesses are different. Only handicap which bakery business has that it's a short shelf life business. So you can't dispatch or you can't have a market beyond 200 kilometers, right? So in like a biscuit, definitely there is an ease that you can produce and make it travel, say 500 kilometers. So if you are supplying from somewhere from a plant in Punjab, I can still send it to Eastern UP, which can travel 400 to 600 kilometers, right? But that's a handicap in bakery business that you need to have a sourcing location which is within approximately 200 kilometers. So that's one big differentiation which is there because bakery products have to be serviced. They have a short shelf life. They have to reach an outlet early morning at 6:37. So that's the one large difference. Both brands are strong enough. Just to share with you, like we launched our biscuits also in 3 cities of West and South, which is Bombay, Pune, and Bangalore. Now, we were very delighted that we got a very good response of acceptance of our brand in these markets in the general trade, which only reflects on the quality and the strength of the brand which is there.
Okay. And any experience from the UP? Because now you said that you have both biscuit as well as breads now in UP as well, right? Any specific markets that you are like, even biscuit is also in the large towns, or biscuit is more in the smaller towns, whereas bakery is...
So, biscuit today is in all large and medium-sized towns. And we have a plan for next financial year where we want to, cover majority of medium-sized towns of UP. UP is definitely a priority market for us in the north of India. And the UP market has started doing well for us. And we have aggressive plan to expand our distribution in UP.
And you would describe the improvement in UP to largely to the implementation of the distribution, GTM and plus DMS and auto.
Absolutely. GTM and a selling execution, improvement in selling execution.
Sure. And sir, last question, just for bookkeeping, what would be the CapEx FY23 you would spend and FY24?
Sorry, I didn't get you.
The CapEx number for FY23 and 24.
So CapEx, I just said, we are spending about 75 crores on 2 lines which we are putting in Rajpura. We have, as I briefed, that we are putting up a plant, expanding a bakery plant in Bhiwadi, where we have an approximate capex of around 22 odd crores. We have an approximate capex which we'll be investing in. This is the 2 particular capex which will mature in the year of 23-24. Rest will be in CWIT, which will mature in 24-25.
Sure. Thank you so much.
Thank you. Our next question is from the line of Alisha Mahavla with Envision Capital. Please go ahead.
Hi, sir. Good evening. Thank you for taking my question. So my first question is with respect to the employee cost, which is seeing a sequential growth. And while we understand that the company is in team building, adding feet on street, when do we expect this to stabilize, or how much more can we expect this to, as the business is going and entering newer markets? What kind of growth are we anticipating?
Can you repeat? You're saying that you want to understand on employee first, right?
Yes. That is increasing sequentially, and we do understand that the company is team building, we're adding feet on street, etc. I just want to know when will we hit a more stable run rate, or what would that number be like?
So, just to brief you on that feet on street is we are adding is on the distributor role. We are adding area distributor salesmen, right? They are not on the company role. So they are a low cost, and that what we will need to add. Even next year we will be adding fair amount of ADSRs to expand our distribution. Because as we are planning to grow our distribution aggressively, and we have a lot of ground to cover, I particularly see that our addition in the sales force through ADSR route will continue for next few years to come. It will not. But yes, we will have our efficiencies coming in, sales as a cost to, sales as a percentage to revenue, right? And as our throughputs of the distributors will keep going up, then they will be more independent, and our support in terms of that cost will keep coming down over the next 2 years' time. So I would say it will take at least 2 more years to kind of stabilize. But yes, we're very confident as we keep growing in next year and next to next year, our cost of sales as a percent to revenue will only improve.
So if I understand it correctly, the employee costs will continue to keep going up, but like you're saying, the efficiencies will ensure the percentage of revenue doesn't cross a certain threshold.
Yes.
And it will take about 2 years to stabilize.
Yes.
Sure. And in terms of other expenses, we've seen almost flat number on sequential basis. So is it because power and fuel is now starting to come off, or is it that we spend slightly less on marketing or during the quarter, and maybe we'll see a bump up in Q4?
No. It's a market. If you look at other expenses, at 19% last quarter, if I remember, that 20%. So it will remain stable around this, right? And because primarily this went up in this year because of 3 reasons, right? One is we had a larger contribution of exports, and exports as well Indian domestic logistic cost had kind of gone up. Second was because of travel, because a year before that travel was literally zero because of COVID and other reasons. Now travel is back, both domestically and nationally. Entire sales team, non-sales team, export team, they're all traveling. Third reason was that we had expanded our marketing investments over the last few months, which we will continue to do that, right? So it will remain stable around this percent.
Understood. And with respect to what an earlier participant was asking, that raw material stocking in the fresh season, and we are seeing some amount of cooling off of RM inflation witnessed last time, the price increases already in the channel. So with the incremental margin, are we expecting to invest that back in the channel or invest it towards maybe building more on the marketing side, or will we consider retaining some of this?
You know, our next year EOP plans are under finalization now, and hopefully within the next by the 15th of March we will be able to close it, and then that's the time when we will truly come to know how we're going to be supporting the whole business. But otherwise, things look positive than the last quarter. We're going to look at the first quarter last year to this year first quarter calendar. So it's going to be, we feel it's better, but the numbers will get closed by probably another 20-25 days.
Okay, sure. And just one last question, considering
Also on the employee cost, when we're talking about feet on street people, increasing our feet on street, that's, those people are not on our rolls, right? So they do not add to the employee cost. So they are only going to help us, increase our sales. So as a percentage, we are going to see a dip in the employee cost.
Yeah, but there'll be an increase in commission which will come in other expenses.
Well, not really, because most of our teams have already joined in, because this last year was more about building infrastructure. If you see 40% growth coming in, this is because of a lot of work which has been done by our CEO, Mr. Manu Talwar, our sales heads, and our infrastructure team, our IT team. There's a lot of work. So most of the people have joined us. So it's only tertiary people who would need to come in. So we don't expect any major costs coming in,
No, I'm saying that while I understand the employee cost, it will not come in employee cost because they are not on our payroll, but some amount of incentive will have to be shared with them, which will probably be part of other expenses, and if not employee expenses.
Yeah. That is perfectly okay. That's okay. Yeah. That's a very small percentage, and it's also linked to premiumization. It's linked to number of things. So also when we count the number of shops, we do not count any shop which doesn't bill less than 200. So when we are going to talk about 320,000 shops, the minimum billing to that shop has to be 200. So, so that is another very big thing, right? So, yeah.
Got it. And just one last question. We are expecting, healthy expansion of our distribution network, and we still have a lot of white spaces in terms of geographies or areas that we have to address. Despite that, our next year growth aspiration continues to be in high teens. Is that slightly conservative?
Yes. We expect ourselves and we want ourselves to grow at high teens.
Okay, great. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one or two per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Vidhi Dadia with Radiant Securities. Please go ahead.
Good evening, sir. Thank you for the opportunity. I have just one question to ask. As per referencing this data point from the Q2 earnings call, the retail reach in new geographies was 5,000. What is the number now, and what is the potential target reach you are looking at?
So current number is 10,000.
10,000.
Yeah.
Okay, sir. All right. Thank you.
Thank you. A reminder to all participants, to ask a question, please press star and one on your touch-tone telephone. The next question is from the line of Resha Mehta with GreenEdge Wealth Services. Please go ahead.
Yeah, thanks. So, if you could highlight that, we had started with direct distribution of biscuits in West and South with Mumbai, Pune, and Bangalore with around 5,000. So, have we added many new cities and if yes, and how are we seeing the traction in those cities?
So, we have finalized a plan for the next financial year to expand in West and South. And we would be adding almost 10 odd cities in next year, but our plan will be hard, and we'll be happy to share directionally how many more cities we want to add in South and West to grow our distribution. So first is we need to also grow in cities where we have launched, because all these three are very big cities. They have a great potential, but alongside we're going to be expanding into the new cities in the next financial year. And so we are discussing and finalizing that plan. We'll be able to share it with you by 15, but there'll be at least 10 more cities or more we'll be adding in the next financial year.
And in the retail bakery side, so again, apart from Mumbai, Pune, Bangalore, Delhi, have we started supplying to cities like Jaipur, Chandigarh, Agra, Ludhiana, like we had called out in the previous calls?
Yes. So we have expanded our footprint very aggressively in this financial year outside of Delhi NCR, which are the cities you are mentioning. And that is also one of the reasons that we are putting up a bakery plant in Bhiwadi, Rajasthan, which is about an hour distance from Gurgaon, to strengthen not only our NCR region supplies, but also to feed into the upcountry cities and make them grow faster.
Right. And lastly, if you could share, what is the revenue contribution for 9 months from modern trade and e-commerce? And we did highlight that there are around 5,000 modern trade outlets, and we are targeting to reach 2,000 outlets by this financial year end. So where are we on that? And would all of Bector's products, so both on the bakery as well as the biscuit side, be present in these modern trade outlets?
So you see modern trade outlets on the biscuit side, there is a universe of around 6,000 outlets, right? And we are, as of now, we have reached approximately 2,300 out of those 6,000 outlets, right? And that's what we had targeted for this year. We have a plan to achieve 50% of that penetration in the next financial year. So that's primarily on our penetration on the modern trade side and the quick commerce side, right? That's where we are.
And what is the revenue contribution from these two channels put together?
So revenue contribution from these two channels is close to approximately 13 to 14%.
Okay. And would it be fair to say that modern trade would be having much higher channel in your revenue in the cities like Western South or and
Sorry, your voice was breaking much higher.
Yeah. So it's fair to say that in Western South cities like, let's say, Mumbai, Pune, Bangalore, the revenue contribution of modern trade quick commerce will be much.
So yes, our modern trade and quick commerce contribution in bakery is higher. But in terms of on a biscuit side, we aggressively started a journey of expanding into modern trade on South and West biscuits primarily from this year only. So our contribution of West and South is started growing well, started penetrating well. So yes, in the next year, you should see a much higher contribution of modern trade, quick commerce, e-commerce for both the sectors.
Got it. Thanks and all the best.
Yeah, thank you very much.
Thank you. A reminder to all participants, please restrict yourself or limit yourself to 1 or 2 questions per participant. Should you have a follow-up question, we would request you to rejoin the queue. Our next question is from the line of Saptarshi Chatterjee with Centrum PMS. Please go ahead.
Thank you, sir. Thank you for the opportunity and congratulations on a super set of numbers. My first question is on the, if you can indicate what would be the differential of retailer and distribution margins for us versus the national players? And for how long, if it is higher, how long period you would be wanting to continue this?
So yes, definitely from the leader, right, who is almost 13x of ours, our retailer and distributor margins are marginally higher than them, right? And we do have a plan as we keep expanding and growing. We would keep rationalizing them over the next few years. As of now, we don't have any definitive plan in place that how much will reduce, over the next 3 years' time. But that definitely is a part of a plan that as we keep expanding and strengthening our territories and geographies, there we will start reducing the gap on our margins given by us versus our market leader in that particular territory.
Understood, sir. And secondly, because we are implementing distributor management system and Salesforce, and we are tracking the sales of our outlets, is it possible for you to quantify or maybe indicate in coming quarters what would be the growth on the existing outlets or maybe the outlets that you have acquired in Q2? What would be the growth on those outlets QOQ? So that we can understand some indication of how the growth in the new outlets or repeat purchases happening on the new outlets.
Yes, we should be able to, with help of SFA and DMS, which we are implementing now. Over the next 2 quarters, we should be able to also look at that data. That what is the growth, what is the frequency, what is the throughput increase. We should be able to look at data and influence and work on that data.
I know it's early days, but is it possible to quantify anything currently?
Fairly correct. You see, all these digitized tracking, they have an accuracy of anything close to 80 to 90%, and they give you directionally correct data for even the best of the FMCG. So yes, they should be able to indicate directionally that how it's progressing, and that's how we also use data to improve our sales performance.
Understood, sir. Very helpful. And last question, what would be the advertising and sales promotion and freight cost in 9 months as a percentage of revenue?
Come again, the sales promotion and advertisement?
And advertisement and sales promotion and the freight cost in 9 months as a percentage of revenue.
Okay, so our sales promotion and marketing sizing expense is almost in the range of 7 to 8%, right? And out of the sales promotion, or you can say that the marketing side, which is approximately 2 to 2.5%, and the rest comes the sales promotion. So that's broadly the kind of a breakup there.
And the freight cost?
Our freight cost of bakery, domestic biscuit, and including exports is approximately in the range of 5%.
Okay, and for the biscuits?
No, this is combined, I said, for the company.
Okay, sure. Thank you so much. This is very helpful.
Thank you. Our next question is from the line of Ayaz Motiwala with Mirabilis. Please go ahead.
Yes, sir. Thank you. Good evening, sir. My question is regarding the other expenses. They've grown very sharply in this particular year and in the last few years. So you have shared an explanation of adding people, also the change of the sales personnel from inside with the movement outside to the distribution staff. So can you share a little more details on that, please?
Let me start with employee expenses first. So if you would notice, on a 9-month period as well as on the quarter, in the 9-month period and a quarter, both we were around 13.6% last year, and this year is 11.9% on a employee cost side. So employee cost side, certainly we have a good reduction in terms as a percentage to revenue over last year, right? So that's it. On a other expenses side, definitely we have moved up 17% to 19%. So I was giving a reason. There are three prime reasons. A, in the previous years, there was literally no travel. So the travel has come back because during COVID years, travel was not happening, both domestic and international. So that travel is back. We have a increase in the freight cost, as you know, fuel cost and all went up. And so
sorry, sir, I'm not able to hear you correctly, sir. The second point was.
Can you hear me now?
Yes, much better, sir. Thank you.
Okay. The other expenses have definitely moved up from 17 to 19%. There are three prime reasons for that to happen. One was on the travel side, because literally during COVID years, there was no travel happening. Now both domestic and international travel is back, and which is necessary to grow the business. Second, there has been increase in the fuel and the freight cost, and our contribution of export has also gone up, which has led to slightly higher jump in the freight cost, right? And also on the fuel side and the manufacturing, there has been a steep increase that side. So that has impacted. Right? Last is that we have augmented our investments on the marketing, which you can see very well in the last quarter also and this quarter. So that's a kind of a third reason, which has led to this increase. But we're very confident now we'll be able to stabilize in this percentage as we move forward and as we keep growing our business.
Sure. So that's very helpful. And just as a follow-up on that, you had just shared to the earlier question, I think a breakup on the sales and marketing investments and the percentage that you talked about.
Yeah.
This 19 odd %, what